Hello and welcome to Wealth Management Insights. I'm Monica Guerra, Head of U.S. Policy for Morgan Stanley Wealth Management, and I'm recording this audiocast on Monday, June 30th. Today, we're diving into a fresh perspective on the energy sector, which has been in focus in recent weeks. Let's get started. First up, let's set the stage by discussing the round-trip path of oil prices this year. Initially, we saw a decline driven by oversupply and fears of weakening demand, partly fueled by tariff uncertainties. Falling prices led to slow drilling activity and reduced rig counts as incentives to produce deteriorated, which was a contributing factor to softer CPI prints this year. But as tensions flared in various geopolitical hotspots, oil prices rebounded quickly to retrace this year's losses. Recent developments have diminished geopolitical risk, and today, WTI oil prices remain similar to their early June levels, but they are down 9% on the year. Of course, given the volatility of oil prices, these dynamics could change. Meanwhile, natural gas tells us a different story. Demand for U.S. natural gas is on the rise thanks to surging export needs, particularly from Europe, and the power requirements of artificial intelligence and data centers. As tech and industrial onshoring continues, the upward pressure on natural gas demand has been especially significant. MLPs and midstream energy infrastructure stocks, which are mostly dependent on export and distribution volumes through pipelines, could continue benefiting from these tailwinds. Next, let's turn to clean energy. Clean energy stocks have been outperforming traditional energy so far this year, despite the administration's support for fossil fuels. This is consistent with a recent historical pattern, when under the previous Trump term, clean energy also outperformed traditional energy and then underperformed during the Biden administration despite robust fiscal support. This suggests that the interest rate environment may have a greater impact than fiscal spending. That said, policy developments do play an important role. The GOP budget reconciliation bill scales back certain provisions of the Inflation Reduction Act, but many Republican states and districts have been the greatest beneficiaries of clean energy projects, which could soften the eventual outcome of the bill. That means that hydrogen, carbon capture, and especially nuclear may see targeted carve-outs or delayed rollbacks. In fact, nuclear energy stocks have soared lately, up around 50% since early April due to a combination of policy support and AI data center tailwinds. The executive branch has issued orders to streamline nuclear development, speed up licensing, and pivot nuclear fuel supply chains back to the U.S. Beyond the political embrace, growing AI demand for power will likely require both conventional and non-conventional energy sources to meet data center needs. We believe nuclear is well positioned to benefit from these tailwinds and continue gaining momentum. This was certainly a whirlwind tour of today's energy sector, with dynamic variables influencing outcomes. For a more in-depth discussion at the intersection of policy, markets, and the economy, please ask your Morgan Stanley financial advisor for our most recent U.S. Policy Pulse report. As always, thank you for listening.